Hello, everyone. So this video is the second video for chapter 12, and we will discuss the disclosure of intangible assets. So this disclosure is tightly related to the category of intangible assets. And as we know, we have different categories of intangible assets. It can be from external or internal. And also it can be identifiable or unidentifiable. It will have definite or indefinite usage life. So in general, at the end of each period, when a company presents a balance sheet for if the intangible assets needed to be amortized, we need to report the total cost, the accumulated amortization, and also amortization expense, and the estimated amortization expense for the next 5 years. You know, amortization, as I just introduced in the previous slides, amortization is like the depreciation of fixed assets. So some intangible assets need amortization. So we need to report this amortization, like the depreciation of fixed assets in the balance sheet. And also for some intangible assets that are not amortized. For example, the indefinite life intangible assets from external or internal, because they have indefinite usage life. So it's unnecessary to amortize the cost, but we need to review the impairment. So, but we still need to report the cost of each major class of intangible assets. And also, we need to separate identifiable intangible assets as a separate line on the balance sheet. And if the intangible assets need impairment, we need to use notes to explain the effects leading to the impairment and the amount of the impairment, the notes, and the method of determining fair value of intangible assets. You know, fair value is it's a kind of measurement need a lot of professional judgment. So, and it's a common usage. Many management, managers want to manage earnings. So we will be very careful about the fair value. So the financial reports need to report the method of determining what kind of a method you are using for the fair value measurement. Okay, and then goodwill. For goodwill, we have a special disclosure. We need to report the amount of goodwill acquired and the amount of AD impairment. But because goodwill is measured as a fair value, so we put this kind of impairment losses into comprehensive income in the balance sheet. So it's this kind of disclosure is to avoid the misleading, this kind of losses and gains are very different from the regular operating income. So that's so it's separately reported as a comprehensive income. And if intangibles are acquired during the period, GAAP requires company to disclose the cost and the residual value and the amortization weight. I mean, what kind of ratio to calculate the amortization in the following years. And also the cost of research and development need to be reported in the income statement. So as we know, intangible assets, the cost, the amortization, impairment, and R&D, all of these accounting activities need to be reported in the balance sheet and also in the income statement. Okay, and then we would like to have a discussion about some specific identifiable intangible assets, like marketing related, like trademark or trade name, and customer related intangible assets, and artistic related, technology related intangible assets. Okay, so the first one is marketing related intangible assets. And you know, we are very familiar with this kind of intangible assets, and it's also very powerful. For example, the logo of Google, the logo of Starbucks. You know what the meaning of the logo of Starbucks? It's you know, the design and the trade name, all of these things actually have some special business meaning, and they can offer some future benefit for the company. So the marketing related intangible assets include the trademark or trade name, like Apple, Google, anything related to marketing, or symbols. So, but usually this kind of intangible assets, the cost is limited because we only use some legal fees as this as the cost to capitalize the this kind of intangible assets. It also includes intellectual domain names, like Facebook spend $1 million to have the intellectual domain name for Facebook. Okay, and also we have customer related intangible assets. So like some companies spend a lot of money for advertisement. And so customer related intangible assets is to promote the relationship between company and its customers. You know, a customer is the original source of the company's value. Any company's value will be ultimately be achieved by its customers. Okay, so the relationship with the customers is a very powerful intangible asset. But you know, sometimes it's very hard to identifiable. So if a customer-related intangibles purchased from another company, that's the amount should be capitalized. So here for all of these specific intangible assets, come back to the general requirement. If it's come from external, then capitalize that. It's like you purchase something, the cost is certain, and we can capitalize this cost as an asset. Otherwise, if it's internally developed, it's directly going to expense. And also, if you capitalize the external acquired intangible assets, you need to amortize the value using a straight line basis. We have a example in the following slides. Okay, and also artistic related intangible assets like copyright. Usually the copyright will for the life of author, the author's whole life, and plus 70 years. After that, the copyright will lose its legal requirement. So the cost of acquiring and successfully defining copyright is capitalized. You know, this cost actually is very small. It's just some legal fee for a lawyer. So the bigger part of the copyright, how the innovation or some writings coming and training, no, this kind of costs cannot be capitalized. Only for the cost of acquiring and successfully defining a copyright is capitalized. Sometimes only 100 or 1,000 of money. So under US GAAP, increase the market value of intangible assets cannot be recognized, because this kind of value increase or decrease, the volatility have a lot of uncertainty. And some bad guys will take advantage of this volatility to manage earnings. So the GAAP require not recognize this kind of volatility. And contract-based intangible assets like a franchise agreement, McDonald's sell its franchise, and it's a so for some for this franchise organizations will buy franchise from the McDonald's, and it's externally acquired, and the cost can be capitalized. And also including a licensing and the royalty agreement, construction permit, broadcast rights, and use rights, and so on. So franchise contractual agreement for a royalty percentage of sales, give the franchisee the right to perform certain functions, to sell certain products or services. Okay, so the initial cost need to be capitalized. And because it's externally acquired. But the continuing fees need to be directly going to expense. Okay, so the general principle is also still capitalize some external acquired intangibles because it's 13 and we have very sure about the cost. So it's easy to capitalize. Okay, and then technology-based intangible assets. Technology-based intangible assets, it's about innovation, and patent is the most important technology-based intangible assets. So, for example, when I was a CFO in a pharmaceutical company, we know the patent in medicine is only 20 years. So, but you know, that's why some medicines, some innovative medicine are very, very expensive because they know they spend a lot of money in the research and development. And then they only can legally dominate the usage for 20 years. After 20 years, somebody can make this kind of medicine, but it still needs some federated application. But so that's a patent. So it's exclusively right granted by the federal and government. Give the all control the manufacturer, sale, or other use of invention, but only 20 years. So if an intangible asset that cannot be renewed because it has a finite life. So another technology-based intangible assets like software development costs. So this kind of technology-based intangibles has its special meaning, and we have a special treatment for the software development costs. And the treatment is we have a technological feasibility test. I mean, if the research and development achieve some goal, and after this test, they say economically, technologically, this R&D, the results is it can be expected to develop a product and have some commercial value. And after this, the R&D result passed the technological feasibility test, the expenses, the spending can be capitalized. But before the technological feasibility test, all of the spending will going directly going to the expense. So after this technological feasibility test, the company can capitalize all of the development cost because after that, the future benefit, the uncertainty will be limited. So the technological feasibility test is a very important day. And you know, here, the definition of technological feasibility will depend on by engineering or some experts. So there is an ethical issue in this area. You know, because this if the engineering or experts say, okay, now the research and development already passed the technological feasibility, then the company can capitalize the spendings. You know, the difference between capitalization and the expense directly is we can allocate the spending into the following many years if we capitalize a cost. Otherwise, for example, the spending is $1 million. If I capitalize as an asset for 5 years usage, each year is only $0.2 million going to the expense to decrease the income. But if expenses is directly $1 million to decrease the income. So usually management want to capitalize this kind of spending and make the expense more smoothly. So, but the gap define the requirement is about the technological feasibility test. So after that, the amortization expense is calculated as the grade amount resulting from either percentage of revenue method or straight line method. We can have an example in the following slides to show that. For example, the company develops a computer video games for sale, and a new development project reaches the technological feasibility at the end of June 2019. So before June 2019, all of these spendings directly going to the expense. And after that, we can capitalize as an asset, an intangible asset. So here I'll say development costs incurred prior June 13 were $1,600,000. And from July 1st to December 31st were $1,200,000. So this $1,200,000 will be capitalized, and the previous one will be going directly to expense. And then the revenue from 2020 will $4 million. And in the following years will be $12 million. And the economic life of the software is 3 years. So we will calculate. So here, in this case, we need to journalize the capitalization of the $1,200,000, and also to amortize the value in the following years. Okay, let's see the solution. So first, the $1,200,000 after the technological feasibility, we need to capitalize. So debit the software development costs, created cash. So software development cost is an intangible asset. And then the amortization will use a principle, say which the percent of revenue method is greater than straight line method. So we will choose the greater amount. That's match to the conservatism principle. So the gap from the conservatism principle from gap requires if for the expense, the greater is better. If for revenue, the smaller is better. So in this case, it's amortization expense. So the greater is better. Why use this kind of conservatism principle is because GAAP doesn't want the volatility of earnings, big volatility. You know, volatility sometimes usually means risk. Psychologically, if a company's earnings volatile very much, today, this year is $1 billion, next year is elective for $1 billion. That's crazy, right? So the accounting treatment want to avoid this kind of thing. So they try to use the option with greater expenses and with smaller revenues. Okay, then we use the 400,000 as the amortization expense. Debit amortization expense created software development cost 400,000. So each year after the software development cost will decrease the 400,000. It's like a depreciations for the fixed assets. Okay, so if the software development for internal use, then it just directly going to expense. In the research development stage. But after the research and development past the technological feasibility test, I mean, here is say the preliminary stage is completed and the management say, okay, the product has a very certain future benefit, then the company can capitalize the software costs. Okay, and then the capitalized costs will be amortized using straight line method in the following usage of software usage life. Okay, that's the second video.